In this video, I will be explaining the importance of statistical analysis in the context of the stock market, but also how to use it to better navigate its volatility. Quantitative analysis is often seen as an advanced tool only reserved for the institutions. But what if I told you that with basic statistical knowledge you can gain an edge too? With the two key concepts explained in this video, you will be better equipped to understand what is happening in the data. Also, understanding one of those concepts will keep you from making a dangerous pitfall that improvised data analysts often make without realizing. At Wealth Umbrella, we use our background in engineering and data analysis to navigate the stock market volatility for more than 2 years now, using those concepts and many more with great success. The first concept I'm going to introduce is all about understanding the data in its own context. Take our phase angle indicator on Tesla. A well-calibrated set of thresholds for capturing buy and sell momentums might be 1.2 and minus 0.8. However, if we apply the same thresholds to Procter & Gamble, they fail to register any significant event. The reason is these two stocks have a vastly different beta value. The beta value of a stock roughly measures the volatility of a stock compared to the S&P 500. Tesla has a beta of 2.29, meaning its price moves a lot more than the index, whereas Procter & Gamble has a beta of 0.41, meaning it moves much less. This difference is confirmed by historical data. Over the last 2 years, Tesla has experienced 224 days with a price movement of more than 2%. In contrast, Procter & Gamble only had 17 such days. And it is not only between two different stocks that different thresholds are necessary. The same stock can require varying thresholds since its volatility is not static. It evolves over time. For example, during the 2022 bear market, volatility was extremely high. This was followed by a period of very low volatility in 2023, with many analysts even discussing a VIX suppression. If we look at our phase angle indicator on SPY, the set of thresholds that worked well in 2022, helping us capture momentum and bear market rallies, would have failed in 2023. In a low volatility environment, the momentum never reached levels high enough to trigger buy signals. The sell signals weren't better, often marking the bottom of a regular pullback rather than the start of a correction leg as they did in 2022. Those examples lead to the following question. How can we make sure that the selected threshold will work over time? The answer lies within the concept of a distribution curve. But first, what is a distribution curve exactly? Let's take IQ score as an example. Here is the IQ score distribution curve, which by design places 100 at the average value. A key property of this curve is how spread out the population is from the mean. The measure for this is called the standard deviation. By design, the standard deviation for the IQ curve is 15 points. But what does standard deviation actually mean? In short, it offers a way to understand the probability of any given value to occur. For example, one standard deviation from the mean encompasses 68% of all the population, meaning most people will fall within this range. Two standard deviations cover 95% of the population, and three standard deviation covers 99.7% of the population. A reason we focus on standard deviation is that it helps to analyze the data in its own context. But how? When looking at an asset, it is possible to compute the mean and the standard deviation of the last X values. It is then possible to compute any new value as a number of standard deviation above or below the mean with the following equation. The result will give us the position of this value on the distribution curve, helping us understand if this value was expected or not. The number of values used to compute the mean and standard deviation depends on the time frame you want to analyze your data on. Now let's revisit our phase angle indicator, but this time, instead of using absolute values, let's compute them as a number of standard deviation from the mean for each stock. This transformation normalizes the indicator across different stocks, making it more consistent. In short, even though Procter & Gamble has less volatility, it is now possible to highlight big moves in relation to its lower average move. This is because we are looking at the values within their own context. Another reason that a high standard deviation is interesting is that it helps identify outliers. If we go back to our IQ example, we can see that Albert Einstein's IQ was estimated at 160, which placed him at 4 standard deviation above the mean. This means he had a higher IQ than 99.997% of the population. Similarly, in the stock market, outlier statistic often indicates something unusual. Take our dark pool indicator, which measures the volume on the over-the-counter market where large institutional investors execute private trades. By expressing this volume in terms of standard deviation, we can detect extreme activity. On February 21st of 2020, just before the COVID-19 market crash, our indicator detected a 6.2 standard deviation peak. Such extreme movements of experienced investor can serve as an early warning signals for major market shift. Looking at the data in such ways might be useful, but it is not sufficient in itself. The ultimate goal for any investor looking at the data is to build a winning strategy around it. But how can we evaluate that a strategy is good enough? This is where I often see many improvised data analysts inadvertently get things wrong. Let's start with an example I recently encountered. In this analysis, a YouTuber uses the Commitment of Traders report in relation to Bitcoin futures. This report shows how different types of market participants are positioned. He then discusses how the institutional long positioning and the retail short positioning preceded the uptrend this fall. He goes on to conclude that since institutions are still short and retailers still long, we are unlikely to see the Bitcoin rise anytime soon. Here, the narrative makes a lot of sense. Institutions are seen as smart money and retailers as dumb money. And since smart money is still short and dumb money is still long, we are likely to see a path downward. Moreover, the reasoning is not only logical, but also supported by a recent data-driven example. Such analysis is actually very dangerous. The culprit taking a logical narrative and supporting it by a single specific example. I could build a similar narrative using the options market. People betting on the options market are usually more experienced investors and they should then lead the market. I would use the example of the first rally out of the 2022 bear market just at the start of 2023. We started to see our option model, which mirrors the options positioning, rise on January 3rd, whereas the real breakthrough came on January 6th. This rally continued for a month, where the options model peaked on February 6th, but the real downtrend really started on February 16th. But believing that this is a hard truth that we can rely on to anticipate market movement is just wrong. Actually, I could make the opposite thesis just as easily with the same indicator with the example from last summer in 2024. Indeed, here we can see that the market peaked on July 16th with a downtrend starting the following day, while the option model only really started to drop on July 19th. It also bottomed out 7 days after the actual bottom on August 5th. Both theses can look right when supported with the right example. However, the reality is that long-term statistic from substantial sample size indicates that our option model leads the market 75% of the time. The relation between options and stock is more complex than the straightforward smart money, dumb money narrative. The key at the end is to know the odds since it's almost never 100% and it's closely related to the sample size. I hope I made a good case as to why a single example is not sufficient to draw a robust conclusion. The larger our sample size, the more credible our conclusions become. This allows us to use historical data to predict future market trends more accurately. At Wealth Umbrella, we sometimes use individual examples to illustrate our point. However, we always back our claim with long historical data or validate the statistical significance of our signals over time. And when it comes to analyzing smaller datasets, we think the best tool an investor can use is the Wilson score. The Wilson score is a statistical method used to estimate a confidence interval from a proportion. Unlike a simple percentage, the Wilson score adjusts for sample size, which makes it more reliable for smaller datasets. Admittedly, the Wilson score equation can look a bit intimidating at first, but the neat part is that you can simply ask ChatGPT to compute the interval for you. Simply provide the hit rate of the signal and the number of times it's been tested in the past, and there you go. Now let's look at an example as to why it is useful. My favorite soccer player, Cole Palmer, scored 9 out of 9 penalties last year, while the league average is usually between 75 and 85%. Although I can say he's very good at taking penalties, nobody would be crazy enough to claim that he will never miss one in his career after only taking 9. That's where the Wilson score comes into play. It reveals that his true penalty conversion rate is somewhere between 70.1% and 100%. And we can say that with 95% confidence. Now let's dive into a more intricate financial example. Many of us recently saw the SAM rule, an indicator with a supposed 100% success rate at detecting recession, fail spectacularly before our eyes at the first time of use. Just a quick reminder. The SAM rule triggers a recession alert when the 3-month moving average of the US unemployment rate increases by 0.5 percentage point or more from its lowest level in the past year. It was presented as flawless with 1963 as a starting point, but a closer look into history adds a failed prediction in 1959. Despite this false alert, it still boasts an impressive 92% success rate over 13 instances. So why did this highly reliable signal let us down at its first use? When we calculated the Wilson interval for these 13 cases, it indicates that the true accuracy could be anywhere from 66.3% to 98.4% with 95% confidence. Aware of this potential pitfall, last summer we proposed tweaking Claudia Sam's original threshold from 0.5% to 0.61%, which is an option you can find in our related TradingView script. This minor adjustment now effectively gives the SAM rule a perfect track record. But let's be real, if you've been following along, you'll know that a 100% success rate doesn't guarantee anything, especially at a small sample size. However, this adjustment still improves the Wilson interval to a more robust 77.1% to 100%, increasing the lower limit by about 11%. In short, when looking at any strategy performance, first start by looking at the sample size. If it appears low to you, it might be a good idea to use the Wilson score to put into perspective the real odds of success. Alright, so that was an introduction to how statistics can help you as an investor. With those two concepts, you are now better equipped to navigate the data we're surrounded with. Not only are you now aware of the sample size fallacy, but you're also equipped with a tool, the Wilson score, to put things into perspective. Our goal at Wealth Umbrella is to help retail investors understand and use mathematical tools in a rigorous way to navigate the stock market. It's by understanding those two concepts and many more advanced ones that we have created a wide variety of indicators both for the stock market and Bitcoin. If you're still here, thank you for watching, and if you found this video useful, do not hesitate to share it with your friends and family. See you next time.